Thank all of you for dialing in to our virtual presentation. I'm Manuj Nikhanj, formerly the president and co-CEO of RS Energy Group, and currently the co-president of the Oil and Gas Analytics Division of Enverus. Jeff, Jimmy, and I really appreciate the opportunity to talk about the combination of RS and Enverus and our ultimate vision as a partner to each and every one of you during these unprecedented times. Now, before we do this, I'm going to share some high-level thoughts on the state of the market, field-level activity, and our production outlook. Now, I don't think this will come to a surprise to many of you. As we all know, the industry has been under significant pressure with the combination of lower demand, closed capital markets, and unsustainable debt levels. If you look at the chart here, we show the S&P Exploration and Production Index, the S&P 500, and the NASDAQ anchored to January 2018. Over this period, energy has returned a negative 67%, while the broader market is up 15 to 40%. And that's already after a tough previous 5 years for energy. Now, as a result of the weak environment in sub $40 oil and $2 gas, we've seen dozens of bankruptcies, and capital budgets have been slashed by over 43% in 2020 versus 2019 levels, as shown here. Now, the reduction in spending has caused a nosedive in field activity and production. Starting with rig activity, currently the total horizontal rig count sits at roughly 220, which is obviously well off the all-time highs back in 2014 at 1,400. And this is actually the lowest level since 2005 when the Barnett, Fayetteville, Woodford, and Cotton Valley were being drilled. If you look at the composition of the rig count, 120 rigs, or roughly 60% of them, are running in the Permian Basin. Now, one solution that's currently under development at Enverus is tracking new pad clearing and frac crews by combining satellite imagery, leveraging our GPS location on rigs, and cell phone telemetry data. So if you look at the chart on the left-hand side here, and we look at pad clearings, we're seeing a peak of about 400 to 500 pads being cleared per month in 2018. And as expected, we see that dropping to just over 100 currently. So that's about 70 to 80% decline from that peak. On the right-hand side, we take a look at active fracking pads, which, if we look back, it was hovering about 200 at the beginning of 2020, bottoming at roughly 40 in May of this year, and it's doubled back in and around that 80 level today, which is what we would expect given some of the stabilization that we've seen in commodity prices to attack some of that DUC build. Now, with the cut in CapEx, the fall off in drilling, and operator shut-ins, oil production in the U.S. has dropped from a peak of almost 13 million barrels a day to about 10.5 million barrels a day today, and we expect it to exit this year at around 11 million barrels a day as shut-ins come back on stream and producers work off some of that DUC build. Now, our outlook for oil prices moving into 2021 calls for a $40 to $45 per barrel, which is reflected in this U.S. oil forecast. On the gas front, the production declines in the oil-centric plays have contributed 40% of the 11 BCF per day in declines that we expect on an exit-to-exit basis. Notwithstanding the subdued demand from the impacts of COVID and LNG project delays, we see activity in gas plays will need to ramp back up to close the supply and demand gap in 2021, resulting in a $3 plus world on average next year, which we've accounted for in this forecast. So the natural next question is how is well performance and economics across plays held up over time? Now, as it relates to well performance, U.S. unconventional plays generally reached an inflection point in lateral normalized economic equivalent production in 2017. Lateral normalized economic equivalence really just means we basically are looking at EUR per 1,000 feet on a discounted basis to get closer to what is relevant economically. So at Enverus, we have run an MVA workflow that disaggregates the change in economic EUR driven by well design, such as spacing, lateral lengths, completion design, as well as those driven by changes in geologic properties, for example, what we would consider high grading or downgrading. So summarizing our conclusions by play, the Midland, Delaware, Eagle Ford East, and Stack Merrimack performance declines since 2017 are primarily attributed to well design. While completion intensities plateaued in these plays, longer laterals and in some cases increased parent-child interactions resulted in lower per-foot recoveries. Productivity in the Eagle Ford West and DJ remained relatively flat between 2017 to 2019, which we would attribute to a plateau of gains from well-designed advancements and limited remaining geologic high-grading opportunities as those plays mature. Conversely, the year-over-year degradation in the Haynesville and Northeast Marcellus reflect a shift to lower quality acreage given the maturity of those regions. When we look at the break-evens of wells drilled in 2019 to today, most of the plays are in that $40 to $55 range for the oily plays, and gassy plays in that $2.50 to $3 NYMEX. Now, these are half-cycle break-evens. You would add, I would say, 10 to 15% if you want to be inclusive of G&A and additional land costs. Now, our expectations is that in 2020, we're going to see performance improvements as operators have significantly high-graded where they drill and complete their wells, given the lower activity levels. Additionally, with the 10 to 15% cost reductions we've seen this year alone, we see potentially $3 to $5 per BOE reductions in break-evens, even if we didn't see an increase in economic equivalent productivity. Now, some of this analysis that I showed here is fairly high level and just scratches the surface. I'm now going to dig a few layers deeper using Midland Basin near Chevron's land and other operators in core Midland County, examining those wells to show an example of where and how technical decisions made every day by companies can impact results in a significant way and ultimately be the difference between profitability and destruction of capital. So what this dashboard here shows, as I'd mentioned, is wells in the Midland Basin in Midland County. Highlighted on here is Chevron's land. These wells represent all operators in this area selected. Now, what we've done here is we've run an XGBoost model to do predicted performance and training a model for every well here shown on the map. So what you can see here between the X and Y, if I look at the first 36-month oil production, the X is the prediction from the model, the Y is the actual 36 months, and what you can see is there's a relatively good fit. Now, what we've done is we've run multiple different completion scenarios for every one of those wells that are on production. So basically, we've run what-if scenarios running multiple completion designs across every one of those wells, and then generated time series predicted well performance for the first 36 months of every one of those wells, and then fit a type curve to every one of those wells, estimated well cost, in order to disaggregate the analysis between understanding the differences between the impacts of completions and geology. So if I look at the scatter plot here, Now what I'm looking at is I've assumed every one of these wells on the map were completed with 2,000 pounds of proppant and 48 barrels per foot of fluid. And each of these dots represent a well, and they're colored by interval. Now, if I look at the x-axis, these have each been binned by spacing by the same zone spacing. Now, what's interesting about this is what it shows is once I've normalized out for completions, I can see major degradation in my oil EUR per 1,000 foot of lateral from going tighter than, say, 900 feet, where I get 72,000 barrels of oil per foot, down to 61,000 barrels of oil per foot. So, a 15% degradation in oil EUR by going too tight. And this is going to be differentiated by zone. Based on that same completion design, that normalized completion design, I can also see which interval is providing the best performance. Here, the Wolfcamp A, B, and also the Lower Sprayberry are obviously performing quite well. Now, one of the things I can also do is I can start to understand the parent-child relationships of each of these wells. So if we look at the spacing classification, each of the wells here are colored by the interwell spacing. So red are tighter wells, blue are wider wells. And what it clearly demonstrates is for that normalized completion, my child wells, where I'm a child well, or where I'm a child well to my near neighbors, results in the lowest productivity from an oil per EUR per foot basis. Where I'm a parent well to my neighbors, or where I'm a standalone well, or where I've been co-completed with one well on one side, this is within the same bench, I get the highest performance. So major degradation. So the timing component is clearly having a major impact on well results. And when you think about the degradation here of 10,000 or 15,000 barrels of oil per foot, you're talking about whether or not you're going to be profitable or unprofitable. Taking all of this modeling into account, one of the other things we can look at is in this area of the play is how much capital has been, or how much value has been left behind by not completing the wells with the optimal design. And I can do this from by interval perspective. So for the upper Wolfcamp B wells, there's over $1 billion of profitability that's been left on the table by not completing the wells in the most efficient way. Now, one observation that I'd say is that one of the most underappreciated aspects that affect well performance is the across zone timing relationship, as somewhat demonstrated in this chart. So spacing, stacking, and sequencing in the Permian is complex due to the multidimensional nature of the exploitable resource and really the multitude of variables that are involved. So just to demonstrate this and illustrate this, if I look at this dashboard here, in roughly that same area, we're looking at a number of pilots. What the shading here represents is where you do not have a carbonate barrier between the A and the B, right? At least a 30-foot carbonate barrier between the A and the B. And what we're looking at is a number of pilots here where they've either been co-developed A's and B's, or where you've had leg development, where the A has been drilled and then you followed up with a B. And so if I just select and look at the B, the upper B, and if I look at the performance of these pilots, just to show you the temporal impact that you can have, what we've witnessed here is where you've either got this carbonate barrier between the A and the B, and where you've drilled the A and then followed up with the B, you don't get a major impact on your EUR per 1,000 feet. They perform relatively the same as co-developing those two zones at the exact same time. However, in those areas where you've got lag development on the B after the A, and you don't have those barriers and they act as one big flow unit, you get major degradation in results, right? So the child well effects from the vertical, looking at the zones vertically, has a major impact. You're looking at almost 15 to 20,000 barrel per foot difference in EUR recovery. And ultimately what that means at the end of the day, if I look at the NPV per DSU for this specific bench, right, you're talking about the difference between $70 million, $60 to $70 million, where you're not seeing that level of interference, or where you've got lag development and you have those flow barriers in place, versus $17 million. So you can see how all of these different complex variables make a huge difference, right? Now, moving on, I'm now going to shift gears quite a bit, and one of the things I want to talk about now is really about what gets me excited about the combination between Enverus and RS Energy. So one of the things that actually gets me really excited is the fact that when you think of the combination of the two firms, Enverus and RS have been heavily investing over the last several years. And in total, over the last 3 to 4 years, Enverus has invested over $1.5 billion. And our commitment to you as a customer is that we'll continue to invest in the future. We know having the right technology, people, and data analytics capabilities in place is going to allow us to help you solve the challenges of today and tomorrow, not the challenges from 10 years ago. In today's commodity price environment, our industry doesn't have the luxury of trial and error. And by having the right talent, technology, analytical capabilities, and partners in place is absolutely critical, because the decisions made today can and will impact the next decade of your resource. So now, shifting gears, I'm going to hand it over to Jimmy Fortuna, Enverus' Chief Product Officer, who's going to talk a little bit more about the combination of RS and Enverus, our roadmap, and some of the cool things that we're doing across the broader Enverus portfolio.
Thanks, Manuj. Appreciate you walking us through that. It's definitely an interesting and challenging time for us in the industry. We'd like to talk a little bit about some of the things that we're doing as newly combined companies to rise to the challenge of helping our customers with this current environment. And so we're going to do that now with a little bit of presentation and a little bit of product demonstration as well. I'm going to start by sharing some presentation material for us. And what we're going to talk about a little bit is some highlights of the product roadmap that we hope you'll find helpful as you look forward to solving key problems in the industry that we face today in a depressed commodity price environment, as well as one in which we have to be ever mindful of cost. From the big picture, whenever we combine product offerings in a situation like the one we have today, where we get the great opportunity to take the best of what Enverus and the best of RS Energy have and combine them into something even more valuable, there's a very high priority placed by our customers on, as much as possible, unifying their experience into a single experience. And that's exactly where we've placed our priority and where we'll start our discussion today. If you take a look here, what you can see are some of our first priorities that we put as part of our greatest importance into placing new data sets into the Prism platform to add higher value. One of the things that's great about the combination of our two companies is actually how little overlap there are between the two product portfolios. While there are some things that both companies had in tandem, there are a lot that we can combine together that neither had. A couple of examples are shown here where we see our rig data, leases, and certain M&A data that the original Enverus possessed that RS Energy had not had previously. We placed a high priority on putting these into Prism because now more than ever, combining these data sets into the analytic platform capabilities that Prism has is something that we can yield some significant value from. The rig information in question is not just current rig locations derived from GPS data on the rig itself, but also historic rig information, which goes back all the way to the mid-1980s. So there's a lot to work with there in terms of understanding rig specifications and performance over time, in addition to current location. A great deal of good analytics can be derived from that. The lease data that we provide is not just the tabular information on what leases have been taken and all the very many details of leases that matter from the standpoint of building and maintaining a position from an acreage perspective, but also spatial representation of those leases to give an idea very quickly at the glance, looking at a map of what those lease positions represent and how they relate to the rest of the data present in the environment. And lastly, M&A data is inclusive not just of operator acreage positions, but a great deal of information on transactions and other corporate data that are of interest when determining different scenarios in an M&A environment. So all three of these data sets, we put a high priority on placing into Prism quickly, and we'll give you a quick demonstration of what some of those capabilities are and where they lead us to in terms of future roadmap capabilities as well. So any of you that have used Prism previously will find this screen familiar. It's a default landing page for the platform where you can see a great deal of details on wells, completions, production, lateral lengths, any number of other variables which are interesting throughout North America and soon actually throughout the world. Here in this case, though, in order to save us time, I've actually done just a little bit of customization by modifying the standard widgets. I'm going to move over to another tab real quickly. And what you can see here in this tab is instead of looking at all of North America, I zoomed into a particular position here on the border of West Texas and New Mexico here in the Permian, where we're actually right on the edge of the Delaware Basin in a little area straddling Winkler and Loving counties on the Texas side of the border. And I did that because there's a particular operator with a position here that is helpful in terms of making an example of how these data sets coming together can be of use. So the first thing I'm going to do is actually turn on one of those layers here. So I'm going to look at operator land and apply that. And you'll see here that we've got an operator position. This is actually a Diamondback position. We're going to zoom into that a little bit. I previously filtered the operator land down to just Diamondback for the purposes of this demonstration. And the next thing that I'm going to do actually is add another layer that we just spoke of, which is the land track lease layer. This is the legal lease layer represented not just as tabular data, but also as polygons on the map that give us an indication of operator positions. So we can now see that the Diamondback position that we had just located here, where I'm hovering my mouse over, is surrounded by a number of leases that are taken out. Now, there's actually quite a lot more leases in this area than are represented here, but I previously filtered those leases down to any which expire anytime between tomorrow and 1 year from today on their primary term. So we're only looking at leases that are actually soon to expire. Now, why is that? Well, we're interested in finding how Diamondback might be able to expand the current position they have, rather than doing something which is significantly more difficult and taking out a different position altogether somewhere else. So you can see that there are a number of lease positions around this area which are set to expire within the next year and may present nice pickup opportunities for Diamondback to put on bolt-on acreage. Let's zoom into some of the details of what that indicates. Over here on the right, I've taken a few widgets and customized them just a little. So here in this top graph, what you see is a box and whiskers plot of lease positions that are going to be expiring in that same period of time by county, and then colored by operator. So here in Winkler County, we can see that there's a number that are there. And we get a rough idea of the size of those leases here on the y-axis, so how much land area they represent. Now down in this next chart, we've got something that indicates who's got the most position that may be expiring in terms of this particular area on the map. And we see that Q drilling here in the top is probably one of the top based on the numbers that are being pulled together here. So let's click on that one, and we'll see that the map changes over to the right, as well as the chart above. And as luck would have it, Q drilling is actually right on top of this position that Diamondback has. So that would indicate that there is a good chance that Diamondback may be in a position to acquire or top lease these, depending on how they want to approach it. And if we go looking at it a little bit closer, we can get a little bit more detail about this that may be interesting to us. So let's go back to the map for a second. We're going to add another couple of layers here real quick. One is wells. We're going to apply those. Now, I've also previously filtered this data set down as well, because what we want to find out is whether or not we've got wells that are actually currently producing or permitted or pending permit. So we're just going to go check that real quickly and look at these well status. And we see that we do have them filtered down to permit pending, permitted, or producing. So if we look closely, we'll see that there are some wells in that status on some parts of this acreage. So it's likely that that one or two of these parcels may be held, but in fact, the rest of them probably aren't. And you can see a couple of those spots right here. This particular area is not usually one in which a non-contiguous set of parcels here would be held by just one or two wells. So it's likely that there's some pickup opportunities for Diamondback in this area. And that's a little bit of what we get indicated from that combination of data. Now, we can also add rigs to this map view, and you'll see those pop up. We don't have a lot of rigs running right now, of course, but we see one over here just over the line in Loving County, which is actually near another position. It's not near the Q position. And if we were to stray up into New Mexico, we'd see a few more running up there. So it doesn't look like we have a lot of wells in the status of being permitted or producing in the areas that Diamondback might bolt on, nor are there a lot of rigs running. So there could be good pickup opportunities. Now, a natural question, of course, that follows is, what's it going to cost us to develop this acreage? It's great from an operational perspective that it's right next door. But with costs being as they are, the actual capital outlay to develop that acreage is obviously crucial, even if from an operational perspective, it's leveraging our presence nearby. One of the things that we have as a future capability that we're working hard on now, and RS Energy had actually begun building this prior to the combination of the two companies, is the ability of not just taking subscribed data that we provide as combined companies into the Prism platform, but also customer data into the Prism platform as well. There are a few examples of those types of things which we can bring in. I've only listed a few here. One I'm going to focus on right now in a moment is cost data. That is the proprietary cost data of the customer themselves. Other types of data from the customer can be brought in, of course, too. Geological grid maps, type curves, production data, areas of interest, any number of other things. But for the purposes of this discussion, we're going to focus first on cost data. The reason why we can do that is because a lot of folks don't know this, but Enverus actually operates the largest spend data network that connects operators to suppliers in the lower 48. So hundreds of the top operators in U.S. onshore use our open invoice network in order to pay their suppliers. And suppliers obviously are using the network on the other side of it. We recognize that gave us a great opportunity to add a lot of value to that data on behalf of our customers, where we can categorize and attribute that data so that they can perform quality analytics on it. And we've been hard at work on that for the past year or so. Now we have the opportunity to bring that into the platform, and we think that's going to make a big difference at a time when the industry really needs it. So I'll just start describing that a little bit. What you see here is anonymized data from an operator. It's not Diamondback, but it shows 6 different subcategories of drilling cost over a period that begins in the first quarter of 2018 and ends in the first quarter of 2021. The 6 categories that we have broken down for this operator spend are OCTG, day rates, fluids, cementing, mobilization, and MPT and Vs. And you can see here that the dominant, unsurprising number here is OCTG. So, you're looking at hundreds of millions of dollars typically being spent in the case of this particular operator in this category of drilling expense. So as we think about developing that acreage, this is obviously a really big component of that, and one that we might want to try to drill into and see if there are opportunities for us to save. So just as a type example, once we get into these categories, and it's important to note that getting this kind of category information for cost data is often really difficult for customers to do, which is why we've been using machine learning technology and other capabilities that we bring to bear to take that data and add categorization and attribution to it so that customers can examine their own data and better learn what they can do in terms of planning and controlling spend. So once we apply that, we can go below the category level and actually look at attributes. So in this particular case, we're within the OCTG category now. We've taken a look specifically at 5.5-inch casing of 110 grade, and we're now looking at price curves by weight over the same period of time at 3 different weights. So we've got 17 pounds a foot, 20 pounds a foot, and 23 pounds a foot. Of course, there are different reasons for speccing different weights here on the casing. There's obviously different well design parameters that would drive the need for a heavier weight than others. And surely everybody's doing the best they can to design the appropriate well and not something that's overkill. But sometimes there may be opportunities to dig in and find out whether or not we might be able to use a different casing weight for the possibility of getting some economy on developing some of those future wells. You can see here from the trends that there are pretty significant differences in price on these casing weights, and sometimes even pretty significant difference of a given weight across suppliers. In this case, we just stuck the example to the different weights. If you were to find an example where a lower weight casing would do for a particular well design, it doesn't take very much in terms of lateral length to add up to 6 figures worth of savings for a given well. And the data that you just saw in terms of the categorization, as well as this attribution below the category level, if we can assign the category for the operator and assign the attributes, we generally find that we can actually assign those invoice costs to a particular well or property. So within that area on the map, we could actually be looking at data that actually pertains to that area on the map from a cost perspective for that customer. I would emphasize, by the way, that this data is the customer's data for the customer's use. This is not available to anyone but the customer that's using the platform. But if they are using Prism and they are using our open invoice platform, it's our objective to combine those experiences in the future roadmap to better enable an understanding at a high level of detail what development cost trends have been over time and how they might be better managed. To that effect, if we go back to the example of the area that we were looking in, and we superimpose the concept of saying that we want to understand that particular type of spend in the drilling category, and then drill deeper into particular subcategories within and particular attributes within a particular category of spend, we could see that in the platform alongside the position. And that's our objective in terms of our strategic roadmap, is for customers that have both our Prism platform and our open invoice platform. We can actually normalize that spend data and bring it to them in the process of doing an in-depth analysis on how they might acquire and develop future acreage based on their own actual real data. So we've gotten some pretty positive feedback from that when we talk to customers about it, and it's something that we're hard at work on. We'll talk next about a few other things that we're working on. So what are the key initiatives for the next era as we look forward to what seems at this point an even lower for even longer price environment? We believe that many of the things that we're working on that you see here are going to be difference makers for customers based on what they've told us. Predictive analytics is something that RS Energy and Enverus have been working on for quite a while and have been making great headway on with providing customer value. We're doubling down on that in the future to make predictive analytics even easier across a wider category of problems that you face. Well placement optimization is a key one. The sensitivity of different completion techniques, well spacing, many things going into what we believe can be great optimizers from a financial perspective as we look forward to a continued era of operating within cash flow and driving returns as best as possible in a low price environment. We also believe we can build deep workflows into various disciplines within the industry that unify in a single platform. Those are land workflows, geoscience workflows, and engineering workflows. We showed an example of a business development and land related workflow a moment ago, but there are many geoscience and engineering workflows that Enverus now has in the portfolio that we're putting into Prism and fusing together there as well. We have more of those to come. One example, if any of you are familiar with Q engineering, is being able to take the very same workflows that a lot of our customers today use in order to book their reserves that would actually take those same type curve data generated in that process and make them available in Prism. So we'll have lots of future fun things to talk about at future installments of ERTech. Over on the right, there's some more strategic things that really kind of leave the engineering domain in a sense and move into some bigger picture things that affect the overall environment in which we make decisions in our industry. One is macro fundamentals, understanding essentially supply and demand and future price expectations for gas and oil, particularly for our customers here in the lower 48, but also for customers around the world. And speaking of around the world, international data and analytics that influence the overall market picture for customers here, as well as providing our customers with operations in the rest of the world with key insights that they wouldn't otherwise get, utilizing the power of the Prism platform and some other capabilities that the companies have built up over the years. Lastly, as we continue to see shifts in the energy mix with additional quantities of renewables on the power grid and a continued retirement of the coal fleet of power generators in favor of natural gas and renewables, this continues to impact future demand projections, most especially for gas, which is seen in the long-term forecasts of many analysts in the industry. So bringing those things together in order to better inform the strategic environment for our customers as they look into the future is also an area of high priority for us as we build future capabilities. So that's just a little bit about what's driving us today and kind of the bigger picture problems that we're thinking about. We'll have more to share on that in the future. Overall, regardless of the category that we're speaking to, one thing that you see that wraps it all up is customer data. That is being able to bring customer data into the platform to make the predictive analytics and the deep workflows of the business much more effective than they otherwise would be. So I'll talk a little bit about that next. What we envision with the Prism platform and the capabilities that the two companies are bringing together is essentially a centralized analytics hub in which the key analytics for the company's business reside in one place and make for the various functional cohorts inside the enterprise able to connect to each other and operate off of the same vision and capability and data sets. So whether it's the engineering team or business development or land or geoscientists or internal data scientists that are operating on that same understanding using a combination of our data sets and their own, they can share those insights, use them to affect each other's workflows, and ultimately to best inform the strategic decision makers in the enterprise. We believe that we're in a unique position to do that well. We've got the rails set for it and are beginning to deliver products and capabilities for customers that do those very things. So that's really where we're ultimately going, and we think that we can make a big impact to the benefit of our customers by pursuing that vision. That's really it. So that's the summary of some of the most recent developments here at Enverus, and kind of the summary of the vision of where we're headed next. Really appreciate everyone's time. And with that, I'm going to pass it over to our CEO, Jeff Hughes, who's going to tell us a little bit more about the company at the high level. And I'll leave it with Jeff at that.
Well, thanks, Jimmy and Manuj. I get to work with some pretty remarkable people. Those are our two great examples. What I'm going to try to do is synthesize what Jimmy and Manuj described kind of into the Enverus strategy. I think they did a good job of talking about, what we're working on right now. And I'm going to try to talk a little more about why we're doing what we're doing. And my hope is you find something we're already doing, you already subscribe to, that gives you more value. And I expect that's going to be true for most people. We find ourselves in a pretty challenging time. I joined this business back in 2016 during the last major crisis, and I recall similar rhetoric about the market, or even about who's going to go out of business or how many companies are going to be left. And really what happened in 2016 was a story of innovation. When faced with existential risk, all of us really innovated and changed what we did every day to improve in a lasting way. And I'd expect that's exactly what's going to happen this time. So with our backs against the wall, we're going to find ways to improve. And it's our focus to do that, to help you basically do more with less. So I'll bring up a couple slides and we'll walk through it. We think it starts with this, which is, this is what our industry needs, which is essentially fewer vendors and more technology partners, more complete solutions, really, and less kind of pieces and parts. And this is our focus, really, is building that future. And I think if tech partners like us really have to dream about the future and think backwards. And so if you think about that future, it's a foundation of comprehensive data, constantly curated for accuracy, and has the breadth of everything you might need. Like, obviously, that's a core foundation of what Drilling Info and Enverus RS has been doing for the last 20 years. We need a way, and this brings up kind of where we're headed, but we need a way to synthesize the combination of public and private data into one set. In order for you to answer some of the complex questions that you have, we have to have the ability to synthesize your private data with public data in a way that keeps your data private. You have to be able to trust us to be able to do that. And obviously, that's what we're working on when we talk about Fusion. We need pre-built analytics on that entire set, meaning the combination of public and private, that you can turn into real information. And obviously, we need to create the common workflows across every discipline so that you can break down the silos that exist in terms of being able to move rapidly. And then lastly, we need the ability to leverage machine learning for predictive capabilities so we can evaluate outcomes given different scenarios, different capital deployment scenarios is one example. And obviously, all of this should exist in one platform, and ideally, it's a cloud platform, a modern cloud platform. And so that's where we're headed. We believe that's where the market should be headed, and not just us. We think that's where other companies should be headed as well. And we'd expect that if you fast forward 5 or 10 years, that is the future. So why now? You can imagine that one of the big why points really is the market. So Manu showed the slide earlier. This is the energy sector and how it's performed versus the broader market. And we know it's underperformed, which has led to this, which is capital spending is down, substantially, clearly year over year. But this started pre-COVID, right? The capital spending, if you look backwards over time, has been going down, which means that we all have to figure out how to do more with less, right? And that a lot of that's going to be through digital innovation. And so that's where we're headed. That underpins really everything from a strategic standpoint that we think about. This, I think, is always interesting, which is why is energy broadly as a market, the world's largest market, a laggard in terms of digital transformation. And we think it's really two core things. It starts with technology problem. The problems we address are incredibly complex. And many of the workflows really didn't lend themselves to web technology even 5 years ago. And so it's only until recently has the cloud evolved in a way where the complex workflows that exist behind the firewall today can even be moved to the cloud. So that's kind of problem number one. The second is really an investment problem. So if you go back to the lack of CapEx or the lower performance, you don't see a lot of investment happening in the space in terms of technology companies like us investing rapidly. In fact, we're one of the few. And that investment is in hundreds of millions and low billions. And so it's not a small investment that needs to be made to move up this curve. And so we want to lead that transformation. And our belief is that that's an absolute requirement for the type of innovation that the industry needs to actually happen. We want to underpin that, and that's our focus. Along the way, we've done a number of acquisitions, and here's some examples. And this is really important because we couldn't have gotten to the position we're in without this. It would have taken dozens of years. And so what we're able to do is synthesize and bring together these companies into one common core platform. Many of the names here, like RigData or OneDerek or Oldex, are names that have been in the industry forever in these kind of separate, discrete workflows. And we want to bring this together into one common platform. And Genstar and Insight have been our backers from a financial standpoint for us to be able to do that. So, obviously, the acquisition strategy is one thing, and then we're investing significantly on the organic side to bring this together. And that kind of culminated finally in the acquisition of RS here recently. And what we're doing is putting all this together in one common platform, investing substantially in the downturn because we believe that we can help our customers get more efficient and ultimately be a leaner and more effective company coming out of this downturn, much like what happened in 2016. That was coming out of this stronger. And so we're doubling down in terms of how we think about that. And the very first thing we're doing is bringing these things together in a common platform because that will, in and of itself, that integration is innovation. It will bring a number of workflows out that could have never existed previously. And so you'll see those things rolling out rapidly and have started already. And the pace of that will be pretty fast as you think about the rest of this year. So appreciate everybody coming. I hope this was valuable to kind of hear a bit about where we're headed, a bit about why this is important to us. Again, my hope would be that that one of these for every one of you ends up helping you find something we're already doing for you that can help you today be more effective. And I'd expect that's going to be true for the vast majority of customers out there. And thanks again, and please stay safe and enjoy the conference.